Hi, welcome to today's session. My name's Simon Butler. I'm the head of mortgages for CMME, and I'm here today to talk you through a couple of different areas. So, particularly focusing on the situation we're in at the moment with the current market and the effects that COVID-19 has had on that. So, I'm going to go through a couple of areas and a few key questions around that we're asked on a regular basis, just to give you some insight into what the market's doing and how that's impacting lending. I'm also going to talk you through what you can do to prepare yourselves to be mortgage fit, whether you're going to move forwards with an application for a residential purchase, whether you're considering actually remortgaging, or whatever type of situation really you're looking at, just to give you an idea of the way that lenders are treating borrowers at this point in time, to give you some insight around that area. Now, just to let you know, I will take questions from today's session, so you can ask those while we're going through this, and I'll come back to answer those at the end of the session. But just to start with an introduction on myself, I am head of mortgages, as I mentioned already. I've been with the firm now for going on 8 years. I've worked in the mortgage industry for over 15 years as a broker, and now managing and looking after many brokers for the firm. We, as a broker, work particularly with independent professionals and freelancers, the self-employed, anyone that particularly has a slightly unusual makeup and way that their income is put together compared to what would be treated as, I suppose, normal in the market, or standards, probably a better way of putting that. So people that are working on a PAYE basis, or perhaps have had a company for many years and therefore have many years of trading accounts. Those are the situations that lenders tend to treat as standard. So we fully understand the way that independent professionals and freelancers work. For that reason, we've got many strong relationships with lenders in the market we've built over many years, and we've actually helped to shape the criteria and the processes that a lot of these lenders are using when it comes to underwriting mortgages for someone like yourself. Now, as I said, what I'm going to do today is firstly address the COVID-19 situation. It's obviously had an impact on the market. It's changed the way that lenders are treating clients at this point in time and the way that they're assessing finances. Obviously, it's also had an impact on the housing sector as well. So, as you'll probably be aware, there's the lockdown itself caused a bit of disruption for several months, and we now seem to have come out the other side of that for the time being. But we don't know how that's going to impact things moving forward as well, given that there's the potentially looming risk of a second wave being talked about quite consistently in the press. So as it stands at this point in time, things have progressed and moved forward since the lockdown has been lifted. So what I wanted to do was cover off any tips, any points that you should bear in mind to get yourself into a position where potentially you can start getting yourself ready to secure a mortgage and talk to a lender when you're in that position to do that. So, looking at the current market, what are we seeing at the moment? What's the situation in terms of how easy it is to get funding and how lenders are treating clients at this point in time? The market itself is fairly comparable to what we saw in 2008 at the point where the financial crash hit the international community and economies around the world. And what it posed at that point in time were many questions with lenders about how they could continue to lend, what they would need to do to change the way they lend, and potentially to try and interact with clients in a market where, to some degree, funding was starting to become very difficult to put together. Now, there's many bits of news around at the moment. Just today, there's reforecasting around GDP. In terms of the fact that the GDP is looking a lot worse than was initially expected. So lenders are going to have to take a lot of these points into account when they're considering putting together funding and considering what interest rates and areas they're going to cover for funding. Now, we do get asked quite a lot, is the market comparable to where we were in 2008? I would say it's actually comparable in some ways and not in others. So interestingly, there are reduced lines of lending. We've seen some lenders at this point in time fully stop even lending, or at least they did for the first couple of months of the lockdown. When we've seen some other lenders, restricting lines of opportunity. So high loans of value options, for instance, is an area that's particularly being hit, and I'll come back to that in a minute and talk about what particularly need to be aware of on that one. But in other ways, we've seen a slightly different market. So Just at the start of the lockdown in March, or just before it, in fact, actually, the Bank of England had actually dropped the Bank of England base rate to a historic low 0.25%. And that was just after the Bank of England last year had actually raised the Bank of England base rate. So straight away, it was a clear sign that the Bank of England were trying to get ahead here and try and help borrowers. And what it's actually allowed lenders to do is, while they haven't wholesale dropped interest rates in line with the Bank of England base reduction, they have actually been allowed, because of that, to continue lending at fairly low levels. So we've seen a lot of very competitive long-term fixed rates continue to be available in the market. 2-year fixed rates are consistently low. For those borrowers that had tracker rate mortgages at the point where the base rate dropped, they would have received the benefit. But what it does mean is that if anybody is now looking for a base rate tracker, the saving hasn't been passed on in entirety across the range of lenders' base rate tracker options for new arrangements. But what it has allowed lenders to do is continue lending and offering mortgages at what's feasibly been a very competitive level and actually historically low for now the last couple of years. So it's a slightly different situation, but I think the key thing is to bear in mind is that lenders are still lending. There's just some additional restrictions that we perhaps didn't see going back 3 to 6 months ago that now need to be taken into account. And obviously the effect of furlough and risk of job security is also a concern for many lenders as well. So we're going to have to see how the closure of furlough in the next couple of months, because that's going to be coming to an end as far as government guidance has confirmed is going to do to the market. So it's an important thing to bear in mind. Now, moving on to the impact of coronavirus and whether it's made it harder to get on the property ladder, it's an interesting point. And mortgage lenders have acted and reacted in very different ways to this issue. But the approach has been broadly similar in terms of what's been changed. So loan-to-value restrictions, as I mentioned already, are one of the biggest concerns. And many lenders are now capping borrowing around the 85% loan-to-value margin. Now, we do see interest rates coming out, and we have seen them on many occasions over the last couple of months coming available for 90%. But 95% loan-to-value mortgages are at this point in time not available. And there's a couple of key reasons for this. Mortgage lenders are concerned with a lot of press and a lot of news that's out there at the moment that property values may actually see a slight slump over the next six months, maybe as many as 8 months. And the key concern around that is that several key commentators in the market, such as Royal Institute of Chartered Surveyors, Nationwide, the Bank of England, Savills, estate agency, are a very good indicator on this one. They're all coming out and saying that property values could dip as low as anywhere between 7 to 15% over the next 6 to 12 months. Now that's quite a large window, and even at the bottom end, a 7% reduction on a property's value is fairly considerable if you think that if you are trying to approach a lender to consider a 5% deposit on a property, there's a massive margin of risk in that for a lender. So it's no great surprise at this stage that banks and building societies have removed 95% mortgages just to essentially curtail any risk for themselves. But what it doesn't do is allow borrowers, first-time buyers particularly, to be in a position where they can take a step onto that first rung of the property ladder. So what it has also then done is put added pressure on 90% options and even 85 to some degree, but 90% options are also, we're finding at this stage, very rare. And a lot of lenders are dipping their toe into the market, offering a tranche of funding for a period of time, and at a stage where they feel that they are starting to be too pressurised in terms of volumes of applications. They're obviously limited at this point in time given staff availability, because a lot of firms aren't still working in offices, they're still working remotely. So what you'll find is lenders will very quickly deal with that situation by just pulling and removing interest rates. And we've seen that on many occasions over the past couple of weeks. The likes of Virgin Money, Clydesdale Bank, Bank of Ireland, even HSBC have dipped in and out of the market as and when they're able to take some business at 90% loan to value, but then actually removing it again. So it's really, really important to bear in mind that if you are considering buying, particularly at the moment, and you have a small deposit, this might be a situation where you need to keep an eye on the market, need to be in touch with what's going on in the market on a regular basis, and also just to just to be aware that at any stage an option may be there for a period of time. It doesn't mean it's guaranteed. Now, what we're also finding as well on top of that is lenders are also adding further restrictions around criteria. So where, in some situations in a standard market, if we go back even as far as 3 months ago, minor credit issues may be considered acceptable or may be considered not too much of a concern. And what I mean by minor credit blips are maybe a missed credit card payment, maybe 1 month late on a utility bill, something along those lines. These are areas now that are going to be scrutinised even more than ever before, and lenders, we're finding at this point in time, are starting to pick up on these as a potential pitfall to not lend and a reason not to lend. So it's really important you review your credit report on a regular basis just to make sure that you don't have any of these issues, but if you do have them, you're addressing them as quickly as possible. So one tip, first of all, I would just say, and I'll come back to this a bit more later in depth, is to consider looking at your credit report on a regular basis. Go to the likes of Credit Karma, go to the likes of Experian, Equifax, get an account and just keep an eye on it just to make sure that everything's okay. Now, what I should say at this point in time now, and this is really, really important because this whole conversation might start to feel as if it's very damning, is that securing a mortgage as a self-employed individual is still possible, but lenders are always going to ask more questions in a situation where they're hesitant. And that's just simply what we're seeing at the moment, where in the past we would have seen a mortgage application maybe go through with a lender in, say, anywhere between 7 to 10 days in some cases with a larger lender. Even those banks are now starting to ask for additional proofs and additional bits of information. So I think, if anything, what you should bear in mind at this point in time is an application process is likely to take, if it was taking 7 to 10 days, it's probably going to take double that now. And the same goes for a lender looking for, say, a 2 to 3 week application process. You have to be aware and you should understand that lenders are going to add a week or so on top of those kind of timescales, just to give themselves that additional time to review the documents and make sure they're satisfied. Now, moving on from there, if we look at the situation around the mortgage repayment holidays, and taking a payment holiday, and one of the questions we're asked quite often is, if I'm a freelancer, if I've taken a mortgage holiday, or as a self-employed individual, if I've taken a mortgage holiday, what kind of impact is that going to have on me when it comes to securing a mortgage, whether you're remortgaging or whether you are, moving home or buying another property. Now, again, with this one, this is an ongoing situation. It's developing because it's early days. We're only really 3 months into this situation when lockdown was essentially put in place. And it was really the point where people started to take mortgage holidays. To some degree, we're only now seeing people that took them in those first couple of weeks actually coming off the back of that first mortgage holiday. Now, we've seen a couple of different reactions to this. Lenders always treat these situations in a very different way depending on how risk averse they are. So some good examples here are that, for instance, the likes of Coventry Building Society, a very large building society in the UK, they're looking for 3 months worth of mortgage payments to be made before they will consider an application for someone. And what I mean by that is someone's taken their mortgage holiday, they've come back to make mortgage payments, and they've made 3 successive mortgage payments to the debt. Now, that's one point of view. We've also then seen the likes of Nationwide currently only requiring 1 month out of the mortgage holiday to have paid 1 month's worth of mortgage payments. So again, you can kind of see there that there's a very different reaction to the way that they're looking at that. And that's just 2 lenders. There are many, many, many lenders out there, and we don't fully know what their point of view is going to be with this until we've actually engaged with them on a regular basis. One thing I should say is that I think every mortgage lender came out very clearly from the start to support the government and said that they wouldn't expect mortgage payment holidays to hit a credit profile in the same way that perhaps it normally would in a normal circumstance. How long that's going to be the case and be deemed as acceptable, we don't know, because again, it's too soon to say. And that's going to be something we need to keep an eye on as well, because again, mortgage lenders, I'm sure, will support the government for as long as they can, but they'll reach a stage where they'll have to start changing that policy at some point. We're also seeing and it's slowed down a little bit at the moment, but we were seeing a conversation building around taking longer term holidays. The government and the FCA, the Financial Conduct Authority that governs the financial sector, were actually calling for longer mortgage holidays, so anything up to 12 months for individuals that were struggling to make payments. Now, it's interesting because Nationwide again came out there as one lender that came straight to the fore to say that they weren't comfortable or wanted particular reassurances if someone was going to take a 12-month break. So we haven't really seen how that's shaping up any further since that was initially talked through about a month or so ago. And I'm not sure what at this stage is going to happen. We're waiting for news to see if 12-month mortgage holidays become something that a lot of people need. But again, it's an ever-changing landscape, and to some degree, this situation is partly going to be linked to what goes on with the furlough situation. You know, we've got many people that will be concerned in the next couple of months about what's going to happen with their employment. So lenders will also be closely monitoring that, and the FCA will obviously be closely monitoring that. But it's important just to be aware of it, because this could become something that people may start to use, and it will certainly impact any mortgage application you make in future. But we don't know how at this stage. Well, I would say at this point in time, and I think it's quite important to make this point to everyone listening to this, is if you are considering taking a mortgage holiday, particularly a long-term mortgage holiday, I would always recommend, first of all, if you can afford to do so, approach your mortgage lender and consider taking a 12-month interest-only repayment if you are currently in a capital repayment mortgage. And the reason we would advocate doing that instead is the lender won't put that onto your credit report as in any way, shape or form some form of mortgage holiday, because you're still servicing the interest on your debt. And in that sense, you're showing that you can deal with the commitment. But it's suitable for the mortgage lender as well, because they'll still be receiving interest during that period. But for many, many people, it can drop your mortgage payment by, just roughly somewhere in the region of about 2/3 of the mortgage payment down from where you would normally be on a capital repayment mortgage. And that's just very much, a finger in the air, and I should add that. The figures could be different, but it will give you a rough idea of what you could save. But given that would then provide the breathing room that many people would require to keep themselves afloat, it may be a better option, and it won't impact you when you come to look at a mortgage application in the future. So just something to be aware of and to think about. Now, probably one of the questions we've received that's raised the most concerns was being on furlough and how that would impact someone's situation and securing a mortgage. Now, mortgage lenders moved quite quickly on this one because it was probably the most present, the most active situation, because it would instantly impact someone for trying to progress a mortgage application if they did go onto furlough. And many people have fallen into this situation where that's had to be the case. So what we're finding at the moment is the majority of lenders, as a general principle, are looking to take 80% of someone's standard income in line with the furlough scheme, rather than the full level of income that normally would be received. And the important thing to bear in mind with that as well then is then looking at the standard income. So again, as a good example, if someone would say a PAYE with bonus or commission income, it's very variable as to how a lender will consider that situation, and you would certainly need evidence from your employer if they're topping up your income in terms of providing commission or anything else to support support you. And if you are going to look to talk to a lender about trying to get that level of income included, you would certainly need to be able to provide evidence. But this isn't a hard and fast rule, and every lender is going to be treating this in very different ways. So one thing I would say at this point in time is we're actually also saying that a lot of lenders are saying that if, until they can see someone has moved outside of the furlough situation, they've moved back to full-time work for anywhere between 1 to 3 months as a rule of thumb, and therefore receiving 100% of their income. Many lenders are going to take the view that they will still use just the 80% at this point in time. So you do need to bear that in mind. It is really, really important when you're considering talking to a broker or a lender about a mortgage, because it may impact your overall affordability. Now, moving on to points and a few tips, things to consider when you're applying for a mortgage. I wanted to just give you a run through of sort of 5 key areas that we would consider talking to anybody about when we first talk to a client, and just give you an idea of the kind of things you should prepare and get yourself in a position to have available as and when we're ready to proceed. Now, first of all, I've mentioned this already, but it's really, really important you consider your credit profile on your report to ensure you've got a healthy score. Now, scoring is an interesting point, because a lot of people believe that a credit reference check or your credit profile is effectively checked and corroborated by your score alone. It isn't. Your score is made up by many different aspects and many different points within your actual profile. So that'll be like things like account conduct, Have you made payments on time? Are you consistent with payments? Do you pay down your debts on a regular basis? It'll be based on how many credit checks you've had in a short period of time. A really, really important one, by the way, and I'll come back to that in a second. And it'll also cover different things like, are you registered on the electoral register? It's a really, really key and important indicator of someone's ability to be found and to provide a lender with what I would say is, I suppose a lodestone to focus their searches upon you. But yeah, there's many different aspects to this, and the credit score is important, but it really is only an indicator of what's going on in the report. Now, as I mentioned just a second ago, keeping up payments on a regular basis is really, really important. And by the way, having credit isn't necessarily a bad thing. It's just something you need to factor into your, when you're coming to apply for a mortgage. You need to be consistent with payments. A lender will be looking for track records because that is how they're going to base a decision on whether they now furnish you with the lending you need for a mortgage. And a £10,000 credit card is obviously very different to a £200,000 mortgage in terms of debt. So a lender's going to want to be sure that you're in a position where they feel comfortable and they feel that they can lend to you. Now, undertaking credit searches, just to come back to this point, is a really, really essential one. If you complete too many credit searches and too many credit checks on your profile in a short period of time, it does actually degrade your score. And I'd be very careful when using websites, to effectively, insurance websites are a really good example of this, where they will ask you if you're happy to be credit scored for the sake of producing a quote. Now, we see this on many, many occasions where someone might not have realised that they've then producing 6-7 quotes in a short space of time. They've actually been credit scored 6 or 7 times, and that can actually have an impact on your rating very, very quickly. So just be very careful when you're looking at your credit report, and do be very careful about what you're doing out there in the market, because a lot of different elements can impact your score and your rating, and it is right now it's probably going to be one of the most important points, if ever, to govern how someone's going to be perceived by a lender. Now, moving on from that, deposit levels when you're looking at purchasing, or the amount of equity you have in your home if it's an existing property and you're looking to secure a new rate, is really, really important. So saving money is really, really clear, but lenders will be looking at how the money has been built up, where it's come from, what the source of the deposit is. We're always asked to produce evidence of the source of the deposit as a broker, and lenders will be looking for a very clear line on how that money's been built up, and they'll ask for things like statements. If it's been provided to you by a family member or someone else, they'll want those statements. So it's important to bear in mind that you need to be very, very clear before you come to approach a broker and then a lender, or a lender direct even, that you have all this information to hand. Now, if you're struggling for securing anywhere between about 15% at the moment, maybe 10% if you're fortunate enough to find a mortgage on that basis as a deposit, then there are other options such as a Springboard Mortgage, which is available through Barclays. There's a couple of other options that are also available for other lenders, where you can actually help yourselves by getting a family member or someone that's willing to help deposit some money into an account, to add as, to some degree, it's a replacement of a guarantee that would have been available in the past, to allow you to get a mortgage and actually take that first step onto the market. So those are a couple of options that are available as well that may help you to do that. But ultimately, it's key to remember that the bigger deposit you have, the lower the interest rate you will receive, and that goes for purchasing or remortgaging. So if we're looking at a remortgage situation, for instance, have a look on Zoopla and check to see what properties in your area are going for and have been going for over the last 6 months. And what I mean by that is try and look for comparable properties, because that is what a surveyor will be looking at. So if you own a 3-bed terrace, they're going to look at 3-bed terrace properties in your area of a similar age and a similar type. If you own a 4-bed detached, same difference. So just bear that in mind when you're looking at comparable properties, because it's really, really essential, because you need to look at it in the way a surveyor looks at it when you're coming to look at roughly what your property should be worth. Now, looking at your spending and looking at bank statements is also an essential part of a mortgage application, and mortgage lenders, even more than ever, are running the rule over what's going on in someone's spending habits and how they are treating their finances on a day-to-day basis. One thing I would say here is really, really key, is if you can avoid going in your overdraft on a regular basis before applying for a mortgage, that is very, very important, at least for 3 months leading up to the application. because most mortgage lenders will look at a 3-month period of bank statements when they come to assess affordability. So get your spending right, try to limit what your outgoings during that period, and try to make sure that you are living within your means, because if an account is consistently in its overdraft and not being cleared month on month by the income that comes back in, then it raises concerns, particularly on a business account, for a lender that's, an applicant isn't effectively living within their means. So just another one to be really, really careful with. Review the marketplace, know what house prices are doing. When you're going in to make an offer, just be sure that you fully understand what is actually going on in the market. You don't want to put yourself in a difficult position where you offer way under what a property's worth and then lose out to someone that's willing to pay closer to the market value. I would say at this point in time, it's probably a good opportunity to perhaps bargain a little bit more than it has been over the last few months, particularly because we are in a position where people haven't been able to sell for the last, 3 months. So do consider that when you're talking to estate agents, but also look at what properties are selling for. Get an idea for what people are willing to pay for property at the moment, because you don't want to be beaten to the punch when you're finally ready to put an offer in. And ultimately, get your paperwork ready. So as I've said, get your bank statements together, get a credit report produced, because as a broker, we often ask clients to provide this because it's really, really useful for us. But also get your passports in order. Clients are always asked to provide passports, driver's license. Make sure your names match the other documents that are used to cross-reference a process. So, for instance, a lender will always be looking to make sure that the council tax statement, for instance, matches a passport in terms of the way that names are made up on each of those documents. Really, really important to bear that in mind. Just make sure you've got all the relevant documents together that a lender would normally ask for. So things like bank statements, potentially pay slips if you're working on a PAYE basis or employed. Proof of earnings in general, so trading accounts, SA 302s, tax overview statements for someone who's employed. All these documents now are becoming more and more required because lenders are being very, very cautious. Now, if you want to avoid any unnecessary pitfalls while you're going through an application process, there are a couple of ways you can do that, particularly if you're looking to buy. So asking estate agents in writing if there's any known defects with the property is a really good way of trying to understand if there's anything you should consider before you move forward with an application. One of the biggest issues we often find when a case gets to, in an application, gets to an underwriter, is if the surveyor returns a problem with the property, such as there's damp, there's issues with the timber, or there's a variety of problems that you could come up against. But if you know about these before you get to that stage, then we can head them off at the pass and already get into the situation where perhaps we advise a surveyor of what they should expect to see. You may be asked to provide additional reports, and that can often delay the process. So it's a good idea to be aware of these issues as early as you can be, so that you can head these off at the pass before we get to them being a problem further down the line. Now, don't take credit out until you've completed the mortgage application. It's really, really, really important. One thing you should note is that even if you have credit reports or loans that you don't plan to use or aren't currently using for anything at all, credit cards are probably a better example here. So say you've got a £10,000 limit on a credit card that you don't use, most lenders now will still take into account that you have £10,000 worth of open credit and quite often hold that against you when they're looking at the affordability of a loan. So it's really, really, really important to bear that in mind. I'm not advocating closing down every single credit card you have, because it's important to show that you have lines of credit and you manage them appropriately. But just consider whether you do need 3 or 4 credit cards when you come to apply for a mortgage. If you're not using all of these credit cards, there's not necessarily a reason to keep them all open. And I certainly wouldn't be securing new finance at a point where you're about to apply for probably the biggest loan of your life. It's really important not to do that. And when you're going forward with an application as well, one thing that I would really, really advocate for everyone looking for a mortgage is be open and honest. Just be as clear as you can with the broker, the lender, whoever you're talking to try and arrange this mortgage, because ultimately things do come out in the wash as we go through the process. Lenders use credit scoring systems and credit profiling systems which actually map every financial institution and every line of credit in the country, whether that be for a car loan, whether you're applying for a small credit card or store card, whatever it might be. If it doesn't appear on one credit report, it doesn't mean to say that it isn't appearing on other credit profiling companies' reports in the background. And lenders will use all of the available information to assess affordability. So you can't hide anything. So just be really, really clear with your broker, your lender, whoever you're speaking to, because it's really, really important you do that, and it will stand you in better stead if we get to a point where there's an issue further down the line. Now, if you have a credit issue, or you have perhaps a low credit report, there are some things you can do to improve that, and I just wanted to run through those briefly. As I mentioned already, being on the electoral roll is really, really important. So how a lender can pinpoint you better than any other source is by providing your, confirming you on the electoral register, because the electoral register will pinpoint you to your address and then provides the lender with a clear track record of address history. So if you tell a lender you've been living in the same address for 3 years and you are on the electoral register, it helps those credit scoring systems to source your information and locate you a lot better than if you weren't on the electoral roll. I'm certainly not advocating voting. That is entirely up to you. This isn't going to turn into a political conversation in any way, shape or form. But it's certainly something you should consider doing as far as registering yourself, because it will help. Now, paying off unsecured debt, as I've mentioned already, really, really helps, while having open credit sources is still something that lenders will take into account. I would certainly consider paying off any debt if you don't need it. It really, really helps to advocate a better level of borrowing. Make frequent payments to your credit source store cards. Don't miss payments. It's really, really important. It might sound like common sense, but one late payment right now could be really, really detrimental. As I've said already, close unused cards. Really, really important not to leave credit open if you don't need it. And try not to apply for new credit, and try to avoid getting quotes from insurance companies who credit score. Many insurance companies, if you go direct, don't credit score at all. It tends to be through comparison sites that this happens quite a lot. So just be aware of it. And even if you are asked to run a check because you are applying direct to somebody, consider whether you need to do that immediately or whether you can wait until the mortgage application is approved. If you're really, really in trouble and you're really stuck, we advocate to all clients who come to us with credit problems that are quite severe and require advice and support to speak to Step Change, who are a debt charity. They're there to help you. They don't charge anything, and they're effectively to help you find financial solutions to your problems. We've referred many clients to them over the years. I would definitely suggest you have a chat with them. Don't bury your head in the sand. It's not going to help you in the long term, and it will certainly help you to get yourself into a better position moving forwards. And ultimately, be realistic. If you've got a low credit score right now and you want to avoid taking higher lender fees and rates, because you're going to have to go to a lender that's going to charge you more because they're the only lender on the market that will accept you, consider whether you should wait. Is it essential to go for a mortgage application right now? Is it essential to proceed with a purchase right now because you have to? Or are you in a position where you can hold off for the next 3-6 months, however long it's going to take you to improve your credit rating, and allow you to then go back to lenders that will offer you a better options as far as rates, fees, and what's available in the market to you. Just consider that, because I think it's a really, really important one, and we'll always help anyone that's looking for a mortgage application if we can. But I certainly wouldn't advocate going directly to a lender to pay higher rates and fees if you can hold off for a little bit longer. Now, one question I'm asked particularly, and this is for freelancers and self-employed individuals, is, do I get less advantage mortgage rates because of the way I work? Now, the straight answer to that is no, not at all. We've worked with lenders, the likes of Halifax, Clydesdale, Accord Mortgages, Barclays, many others for many years to source funding and mortgage options for clients, to work in a slightly different way, and are working in a way that in the past wouldn't have been deemed to be acceptable. And what we're trying to do is just to make sure that we can secure funding for our clients, because ultimately you work in a way that isn't and shouldn't be seen as detrimental. You're just working in a slightly different way to perhaps many other people, PAY individuals, employees do tend to, but it shouldn't mean you should be shut out of the market. So what we need to do is just present your application in a slightly different way, and we provide and support your application in a slightly different way, just to make sure that lenders, underwriters are satisfied that your income is consistent, you've got a good track record, and you can prove that your employment has sustainability. But understanding what a lender requires up front is essential, because you can't just walk into a high street bank to do that. We do often have to speak directly to underwriters to lay the path before an application is provided, to make sure that you are going to be in a position to do what you want to do when you're ready. So one thing I would say is it's really, really important when you're getting to the stage you want to actually talk to a lender, or you're considering putting an offer in, or you're considering going for a remortgage. Talk to a broker first of all and understand what it is you need to do to provide to get the mortgage application, and start understanding what it is you're going to need to do to proceed, because it will save you a lot of time in the long run, and ultimately save you a declined mortgage application because your case was put forward in the wrong way to a lender that ultimately perhaps you shouldn't have been going to in the first place. Now, moving on to first-time buyers, or to some degree anybody considering buying, I would say this is quite important. Fees that you should consider are going to be charged, and other bits and pieces that are going to be potentially charged. Stamp duty is still there, but for any first-time buyers buying under £300,000, it's not actually charged at all, and is only then charged for anyone on a standard basis, anyone moving home, over £125,000 worth of value. Bearing in mind, when I'm recording this could change in the future, so it's really important to keep abreast of what's going on in the market and make sure you're checking HMRC's websites for up-to-date figures. But at this point in time, that's the figures that you should bear in mind. Solicitors' fees when you're looking to proceed with a mortgage application can vary. A good solicitor will probably charge you for a purchase anywhere between, I would say, £1,100 to £1,200. If you are selling, you have to bear in mind that there's normally additional fees as well, because you have to deal with the solicitor has to deal with the process of actually arranging and selling your existing property. For a remortgage, fees could be anywhere between a couple of £100 to £400 to £500. But what actually a lot of lenders will do now as well, when it comes to remortgaging, is actually provide you with the option for cashback, and we often advocate that as an option for people looking at remortgages, mainly because we feel that the free legal services that a lot of lenders provide are often not great. They're a volume-based business, and lenders, while they are recommending these solicitors and giving them to you as a free option, they don't really tend to weigh in when difficulties come. And as a broker, we often get left in the middle of that situation because we don't have very little control, and the solicitors won't listen to us, but ultimately the lenders very rarely want to step in and deal with them to actually rectify the problem. Now, lenders will say whatever they want based around that comment, but from experience I can quite honestly tell you that is an issue. We would prefer normally to recommend to a client taking cash back, and then taking a solicitor that you know that you can deal with and actually have some weight over, because you've instructed them yourselves to actually get any problems rectified. So that's just something to bear in mind when you're looking at a remortgage. Now, on the valuation side of things and surveys, just staying on the subject of a remortgage, most surveys are usually covered as free if it's a basic valuation, just to check the value of your property. If you are buying a home, many lenders do actually offer free valuations to entice people in to secure the business. But quite often when you're buying a property, especially an older property, something more extensive like a home buyer's report or a full structural survey would normally be a preference. So you should cost in that you're probably going to spend anywhere between £300 if you do have to pay for a basic valuation, anywhere up to somewhere between £600 to £700 for a home buyer's report, and even as much as £800 to £1,000 for a full structural survey. So there can be quite wide swings between what you're actually going to pay. It very much depends on the age of properties, and I would just bear that in mind when you're looking at funding. Lenders' fees are chargeable if you want a competitive interest rate. Rule of thumb is an average. Most lenders do charge somewhere in the region around £1,000, whether it's for a remortgage or a purchase. You can normally add the fee to the mortgage, but some lenders will factor that into the overall affordability. They may even factor that into the loan to value. But you can pay that upfront if you prefer. It's entirely up to you. I should also say if you add it to the mortgage, you will be paying interest on that while it's added as well. So it's really important to bear that in mind. But yeah, one final point as well. I would just say, look, just have maybe £1,000 or so available, because you never know what's going to come up that's spare. Any number of issues could come up as well, and you've obviously got home moving cost as well if you are moving home to consider. So it's always useful to have a bit of surplus cash available in case something comes up that's a problem. That's basically it for today. So I've received a couple of questions I just wanted to address while we were going through today's webinar. What someone's just asked, Mike has just asked, I have a 5-year fixed ending very shortly, what should I do? Just as some present feedback on this one. It's I should say it's June of 2020 for anybody that's watching this video at a later date. Right now, at this point in time, 5-year fixed rates are still very, very good value, and there's some really, really good long-term fixed arrangements out there in the market. So if you're looking for security because you don't plan to move home anytime soon, taking a long-term rate again is still really, really good value, and there's some very competitive options out there. Now, if you're considering shorter-term rates, they're equally as good, and if you have no concerns that interest rates are going to go up anytime soon, you can still save a lot of money by going for a short-term rate if you consider and you believe that interest rates aren't going to go up in the next couple of years, because there's no harm in taking a short-term rate now and then looking at your options again in 2 years' time. Also, if you're in a situation where you want a bit more flexibility and you're thinking that you might do something further down the line, maybe in terms of selling, moving, or simply that you want to look at something that isn't currently available in the market, you can take a early repayment charge free option with many lenders, which will allow you to come out of that mortgage at any point in the future when circumstances may have changed. Say, for instance, you wanted to move home and values have come down to a level you wanted to see, and therefore you can then come out of the mortgage arrangement to get the size of the mortgage you require, or to put down a smaller deposit at that point if that's something you wanted to do. So it's just a couple of things to bear in mind when you're looking at interest rates. We've also, just been asked by Carol as well around what we see coming up in the market for freelancers next year. I think Carol's alluding to IR35 particularly there. The IR35 situation for freelancers and contractors is obviously a very, very key point. Obviously, we saw the government put a pause on that for 12 months, and we have no idea what's going to happen with that situation coming into next year. As a gut feel, there could even be a situation where if the market hasn't significantly improved, that may be pushed back even further to allow freelancers to continue working, to allow the economy to move forwards and get back on its feet even further. I would say that might not actually be a surprise, but we certainly don't have any idea of what's going to go on in this sector at the moment in terms of IR35, and it's very much a watch this space. So I'd love to give you the golden ticket on as an answer to that one, but we certainly don't know at this point in time. So just keep abreast of the news and keep an eye on what's going on in the market. That's it for today. I wanted to thank you for your time. I really appreciate it. I hope it's been useful, and we will look to produce more webinars in the future. So thank you for your time today. Please get in touch with us if you want to have a chat with a mortgage consultant and you wanted free, no strings attached initial chat to understand what your options would be. We've got many consultants that are available. We are working from home Monday to Friday, and can fully support you if you do want to get in touch to have a chat. Thanks for your time, and I hope to speak to you again. Bye-bye.